Hello, this is Marsilio with a market update on how low can this go. This is the S&P with yearly pivot levels and moving averages only on a weekly chart. And my view is technical bear really became full-fledged in April, where we have a close below the yearly pivot, below the weekly 50 moving average when it's rising in purple, and that rolled over to a negative slope shown in red there mid-April. And it's been a while since we've had a real deal bear market. We've had several kind of bear cubs, little bear scares that really quickly came back in the 2010s. But it does seem like what we got now is quite a bit more serious. And so I thought I'd look at three previous real deal bear markets just to see and compare if something like that happens again, where we would end up, just roughly. So the last real deal technical bear was in 2007. Here's the S&P. High was in October, closing low early March 2009. So that was 73 weeks and a close-to-close decline of about 56%. And I'll get to projections in a minute. Before that was the 2000 top, which was much more severe for the NASDAQ, working off the excesses of the dot-com bubble. Kind of benign for the Dow, but S&P was in between. The top was in March 2000, closing low October 2002, so 132 weeks, get pushing 3 years, and even kind of a higher close test low in March 2003. So the full 3 years of downside there. And again, a similar decline, 47%. And then before that, really, it was the 70s, although I'll say more about 70s in a minute. There was a top early 73, big plunge in 74. This one was 91 weeks for a decline of 48%. So it's interesting that the percentage declines on all three of these were kind of similar, 56, 47, 48. So if we get around a 50% decline from the closing high level, that would put S&P at 2,400, which is a lot lower than here. It would be back near the COVID lows. Now, I'm not saying this, giving you bear scenario, bear case. So, I'm not saying, don't interpret this as S&P is definitely going to 2,400. But if we do have a 50% drop, like previous real deal bear markets, that's where it would be. The other thing I looked at was valuation, and I'm using forward PE and kind of Ed Yardeni. 2007 was interesting top because it was not really an extreme of valuation. I think because financials were leading, it's actually near 15 forward PE, and then the bottom was near 10. Now, note these levels are in flux because they reflect the profits of the S&P companies. So in 2008, the profits were falling off a cliff, so the level was declining sharply, so they can kind of adjust in time. And then in 2000, the top was all the way near 25, and the low was near 15. So the decline of 10, multiple of 10. And then from another source, I found this in the 70s, the high was actually PE and went all the way down to 7.5. So the 2007 was actually the most benign in terms of a valuation adjustment, but these range from about more than 30% valuation drop, 40% valuation drop, to more than 50% valuation drop. An average of these would be 45% valuation drop, and the high was about 22.5. So again, if we had an average of these three, we go down about a valuation multiple of 10, and we'd see a PE of around 12, which right now projects to 3,000. Now, I don't know if we'll get as low as 12. A lot of things have changed. But, with inflation and the Fed, we can't rule that out. I think the most difficult thing to assess is that we really haven't seen a market that hasn't been supported by the Fed in many, many years. And this is the Fed's balance sheet. Understandably, they came in during a crisis in 2008. But what has always baffled me is that in 2011 it was really more to do. It seemed like the euro wasn't really a crisis period in the United States, but still they increased the balance sheet, and then they leveled off. And again, 2013, there was no crisis at all, and there was no recession. There was not even a hint of recession, and yet they increased the balance sheet. And this period of balance sheet unwind, did scare the market when it was combined with rising interest rates, and that was somewhere in here we had a 20% drop, and then kind of Powell changed his tune, and then another crisis hit, and they just went, crazy to move the balance sheet from under 4 trillion up to 9 trillion in a couple of years. So I don't really know how committed they are to getting the balance sheet back down to pre-crisis levels. They may never do that, but also they could. It's really hard to say. But the combination of the balance sheet unwind and rising interest rates. So as long as inflation is coming in on the high side, they're going to be forced to hike. And the cost of capital, and the risk-free rate, which everyone got used to with the 10-year, under 2, is coming back to historical norms. And, this is going to shake up markets as long as this exists. And that's why the inflation news was so negative. So back to market summary. And now, my particular special with Astro. I'm going to look at 3 types of charts here. And what I'm pointing out is that once a bear market was in play, it tended to go on until we had a change in one of these movers. So this chart shows Pluto terms. For those new to my work, the terms are divisions of the zodiac. And so each color shows term position of Pluto. So we've got Mercury, Venus, Mars, Jupiter, or Saturn. And the first time into Mars was part of the rally, but the second time into Mars here was very near the top, actually, within a few days. And what I wanted to point out was the last high, Mars did go a little higher, but once the bear market started, it took a change of term to change the market environment. And that's the 2007 top. Here again, 2000, this Pluto term position was the entire 90s run up from 1995 all the way up to 2000. And then a term change into Venus was the entire drop. Now, Venus isn't typically negative, but in this case, it was worse than Jupiter beforehand. There was also some other things going on, but it took a Pluto term position change to change the market environment in 2000. And then once again in 1974, this shows the Pluto term position all in Saturn. So this is Pluto in Libra, Saturn, and that was the entire drop, and it took a Pluto term position to change the market environment. So check in terms of Pluto term position. So the point here is, if Pluto in term of Mars is turned bad, which now seems to be the case, we're dealing with that until March 2023, and then it's not even done. It'll go back to that in June 2023, and then all the way to early 2024. So it just based on this, it's quite possible that we have another, extended bear market, and this would be completely in line with the timing of some of these others, because we really just only started. The top was early 2022, so all these bear markets were, way more than 52 weeks. So that's the Pluto view. Saturn in Aquarius was largely positive due to, Fed coming in with guns blazing right at the low and the sign change. In 2007, Saturn change was a huge part of the top and dropped. This was Saturn in Leo shown in gold, and that was the real estate bubble. And when that ended, that was it. The entire drop was Saturn in Virgo. And, once Saturn changed signs, the market changed character. And, the whole bear market was Saturn within that one sign. Going back to 2000, here's Saturn in Taurus, shown in green. The bear market, mostly, not completely, Taurus had already rolled over. Saturn in Gemini is also dealing with nodes and Pluto. But, Saturn sign change took into Cancer, kind of stabilize. And then once again in 1974, Saturn in Cancer for the drop, although it did come back within Cancer. So it wasn't really at the lows here, but it did take, and Leo was not that impressive. 70s were a difficult period with a lot of sideways, as you can see from late or early 1970, and not really going anywhere for most of the decade. But we also keep in mind that we kind of had a decade like that from the 2000 top to 2010. So hopefully that kind of major sideways period is already behind us. And then lastly, the North Node, which also changed sign near the top. And it does seem like the North Node in an Earth sign, given supply chain, given commodities, is part of the inflation worry. There's like a grasping for material, people maybe stockpiling, or there's some distortion in material things. And so if this is part of the inflation story, it may not just be Jupiter conjunct Neptune and Pisces, but if North Node in Taurus is part of this inflation story, we may need a change of sign in North Node, change the market. And similarly in 2007, entire bear market was North Node in Aquarius here. And then 2000, it's really spanned two signs. Again, North Node in Gemini was dealing with Saturn and Pluto. That was part of this big, big slide. And then 1974, all the drop, North Node in one sign. So going back to, I've already mentioned Pluto's going to be in term Mars through most of the 2023. Saturn will be in Aquarius through early 2023, again, March, and North Node will be in Taurus through July of 2023. So my point here is, it just cannot be ruled out that an extended bear market is really just underway. And, my goal in a bear market is not to lose. It's not a buy and hold environment. It's avoid losing money. Investment positions are out. And it's a swing trading environment, which can be phenomenal for swing trading. Also think of those 70s sideways periods. Like if you bought and hold, you literally just had nothing for years at a time, but there's phenomenal opportunities to swing trade. Now, for those who are just care about cryptos, cryptos are not going to rally until S&P stabilizes, and cryptos are likely to be even worse. So a last point here, another more kind of bear scare is technically where did these bear market lows come in given the pivots? So in 2009, Dow reached yearly S1, but that was after plunging all the way through yearly S3 in 2008. So if we see a yearly S3, there's a lot of room between yearly S1, which just broke, and yearly S3 down here, which is 2870. In the 2000 top and drop, S&P traded below yearly S2 in 2001. So that right now that's about 3270. And then again in 1974, it moved below yearly S2. So these bear markets are, really tough. But even if we say, okay, yearly S1 is broken, there's potential to see yearly S2, which would be 3260. That's not even that far different than the valuation level that I implied. If we saw an average of the valuation drop, that would put us near 3,000, and then even just the 50% drop, which is typical of bear markets, is lower, is 2,400. So that's the bear scare. The positive side, or the alternative bullish side, is that what typically, there are a few things that stop bull markets. We have leverage extremes, and just, people are going crazy like .com era. But really, innovation growth continues to drive investment, and AI is developing at an extremely rapid pace. So I do not think that we will be in an extended period like the 70s, although again, that Fed balance sheet is really the tough part in this judgment. But it does seem like the winners of the AI race in business applications will be the next leaders. So those are the ones I'm keeping an eye on. Thanks for listening. That's today's market update. Hope that was helpful. Marsilio signing off.